Hello, myself R. Shilpa, Assistant Professor, Department of BCom PA, APG College of Arts and Science. Today we are going to discuss bank lending and credit management. Lending is one of the primary function of commercial banks. Bank collect the deposit from the customers and provide the loans to the individuals, business and industries. However, before granting the loans, bank follow the certain principles and evaluate the borrower's ability to repay. Principles of sound bank lending. Bank cannot lend money without the proper planning because they deal with the public's deposit. Therefore, they follow the certain principles of sound lending to ensure the loans are safe and profitability. The first one is safety. The first principle is safety. Bank should lend the money only to the borrowers who are capable of repaying the loans along with the interest. Before guaranteeing a loan, banks examine the borrower's financial position and the repayment capacity. Liquidity. Banks should always maintain the enough fund to meet the withdrawal needs of the depositor. Therefore, they prefer loans that cannot be recovered within a reasonable period. Profitability. The main objective of a bank is to earn the profit. Loans are the important source of the income because banks earn interest on them. Hence, lending should be profitability without increasing the excessive risk. Security. Bank usually ask the borrower to provide the collateral such as land, building, vehicles, or the fixed deposits. This security protects the bank if the borrower fails to repay. Diversification. Banks should not lend all their money to a single person or one industry. Instead, loans should be diversified across different sectors to reduce the risk. Purpose. Loan should be granted only for the genuine and the productivity purpose, such as education, agricultural, housing, business, or the industrial development. Loan policy. A loan policy is a set of guidelines prepared by the bank for guaranteeing the loans. It helps the bank to decide who is eligible for loan, the maximum loan amount, the type of security required, interest rates, repayment period, and the documentation procedure. The main objective of a loan policy are to minimize the lending risk, to ensure the profitability, to maintain the liquidity, to provide the uniformity in lending decision. Factors influencing the loan policy. Several factors influence the banking loan policy. The first one is economic condition. During the economic growth, banks lend more. During the recession period, banks become more conscious. RBI guidelines. Bank must follow the rules and regulation issued by the RBI regarding the lending and the interest rate. Bank resources. The amount of deposits and the available fund determine the bank's lending capacity. Credit risk. Bank access the possibility of loan default before granting credit. Customer profile. The customer's income, employment, and the business performance are carefully evaluated. Market competition. Banks also consider competition from the other financial institution while forming their loan policy. Content of loan policy. Explanation. Every loan policy contains several important components. The first one is loan objective. The second one is eligibility criteria. The third one is documentation. The fourth one is security. The fifth one is interest rate. And the sixth one is repayment terms. Evaluating the credit applicants. Ex- Before granting a loan, bank carefully evaluate every applicant. The bankers considers income, the credit history, the repayment capacity, the business performance, and the collateral. Loan supervision and the credit approval. Granting a loan is not the end of the lending process. The bank continuously supervises the loans to ensure that the money is used for the intended purpose. Loan supervision includes monitoring the loan utilization, checking timely repayment, reviewing the borrower's financial performance, taking correct actions if the repayment problems arise. Loan approval depends on the loan amount. Small loans are approved by the branch manager. Medium loans may require the approval from the regional office. Large cooperative loans are sanctioned by the credit committee. Prudential limits and the risk rating. Bank follows the prudential limit to avoid the excessive lending. This limits includes exposure limit, capital adequacy requirement, RBI lending norms. Bank also assign the risk rating to borrowers: low risk, medium risk, and the high risk. Low risk borrowers with excellent repayment history. Medium risk borrowers with moderate financial strength. High risk borrowers who have weak financial position or poor repayment records. Risk rating helps the bank that includes whether to sanction the loan, how much to lend, what interest to be charged. Civil score and NPA. One of the most important factor is the loan approval is the civil score. Civil in the India's leading credit information company. The score ranges from 300 to 900. Above 750 it is generally considered as a good score. A high score increases the chance of the loan approval. A low score indicates the poor repayment history and may lead to the loan rejection. A loan becomes an NPA when the borrower fails to pay the interest or the principal for more than 90 days. NPAs reduce the bank profits because the bank stop earning the interest and may not record the loan amount. Conclusion. To conclude, lending is one of the most important functions of the commercial banks. However, bank must ensure that the loans are granted responsibly by the following sound lending principles and the proper credit evaluation: loan policy, credit appraisal, risk rating, civil score, and the effective supervision helps the bank to reduce the bad loans and improve the profitability. By maintaining a balance between the profitability and the risk, bank contributes to the economic growth while protecting the money deposited by the customer. Thank you.